we are coming up here. Well, it's 5:30 exactly right now, split down the middle. If you're just joining us out there, listen, a lot of people are stuck at home or they're working hard all day. They're not just sitting there watching the markets all day like we are. So let's go now to Bob Pisani to talk about the day that was. And Bob, you've been down at the NYSE now for how long? You're not trying to date yourself, but how long have you been down there for us?
23 years I've been the floor reporter at the New York Stock Exchange, and you don't see days like this very often, Brian, thank heavens. It was a double whammy. That's the problem. The inability to figure out the economic impact of coronavirus on corporate earnings, well, that's bad enough. We had to deal with that. Then you throw in a sudden price war between the Russians and the Saudis on oil, and you have the makings of a very ugly day and a particularly ugly open. That's what I concentrate on here. Within 3 minutes of the market open at 9:33 a.m. Eastern Time, the stocks were halted system-wide due to circuit breakers that kicked in when the S&P dropped 7%. That triggered a 15-minute trading halt. This was the first time that the modern circuit breakers had kicked in, and it did its job, basically. The job was to pause the market and create liquidity. Stocks then rose when the market reopened 15 minutes later, but the damage was done. We ended right near the lows for the day. Energy stocks in particular were clobbered. Exxon down 12%. That's the lowest close since 2004 for Exxon. If there is a poster child for the woes for energy, Halliburton, 3 trading halts, one for the S&P 500 at 9:33, and then 2 individual trading halts at 10 a.m. and 10:22. You see Halliburton closing down about 37%. Other economically sensitive groups also got hit hard, particularly banks and industrials. J.P. Morgan down 13% or so. That was the worst decline since the financial crisis in March 2009 on a single day. Industrials like Boeing, Caterpillar, United Technologies all down 9 to 13%. This wasn't, though, a complete bloodbath. We finally saw some differentiation in the marketplace. Some stuff held up a little bit better than others. Generally, they were consumer names, and not just Walmart. Walmart was the only stock that was up for most of the day, not at the close, but most of the day. Defensive names, Pfizer, United Health, down, but outperformed the broader market. Same with Procter & Gamble, same with Johnson & Johnson, same with Pfizer, all down 3 to 4%. Horrible days, but far outperformed the broader market, down 7.6%. Only good news here today is the circuit breaker did serve to sort of halt the horrible sentiment at the open, and the reopening things were a lot calmer. And the VIX, in fact, did drop after we reopened, although still very, very elevated. Brian, back to you.
Well, Bob, we are glad that you are down there. 23 years of historical knowledge and wisdom in dealing with this. Never flustered. Bob Pisani. Tim, you lived in Russia. I want to ask you a question about OPEC, because if oil helped drive us down, okay, here's the thinking. And I wrote about it this weekend, by the way. I think it's still up on CNBC.com. The Russians ostensibly wanted to punch U.S. shale in the face because Trump put sanctions on Rosneft. Rosneft is the big Russian oil company. It's run by Igor Sechin, who is Putin's former employee and ostensibly best friend.
Well, Trump didn't put sanctions on Russia. I mean, those were legacy sanctions. But
on Nord Stream, and put it this way: if the two can talk, you think there's any chance that there's anything we can do, back channel, to get Russia back to the table with the Saudis and get the OPEC deal done, which might stabilize oil and thus the market?
Yes, but ultimately you have to ask what is Russia's negotiating tactic and what are they trying to achieve? And you know, my view, having spent a lot of time in Russia, is first of all, I can just tell you that the oil and gas industry gets more profitable as the ruble devalues and we get in crisis moments, because actually the oil prices are at higher levels of taxation, at higher levels of oil, but more importantly, they have local ruble-based costs, which actually get cheaper when the ruble devalues, and they are dollar exporters. So they're much more profitable in this kind of an environment. So Russia doesn't mind this environment. They also have a budget which fiscally breaks even at $43 a barrel. Saudi's at 85 a barrel. So who's got more pain on the budget side? And Saudi's been very clear about their move away from oil and their 2030. And the chaos in Saudi Arabia right now that we're also hearing anecdotally, I think is something that Putin is seizing. This helps Putin's negotiating in the Middle East. Putin's got a game plan. He's got a game plan of helping Venezuela, other wounded OPEC players. This is part of the whole tactic. And I don't think Putin needs to rush to the table here, frankly. That's just a view. And therefore, it's a view I have that this volatility doesn't serve anybody. But U.S. shale is free cash flow positive above 50, and Putin knows that.
Yeah, what's interesting is I thought we wanted lower oil prices. I thought we wanted lower rates. I thought we wanted a lower dollar. Now you're getting everything you want, and look what's happening to the market. Sort of be careful what you wish for thing. So I'm sort of with Tim on this thing. I don't see any compelling reason for anybody to go to the table. It is it's economic warfare, and it pains me to say it. Right now, we appear to be losing.
42 used to be long-term support. This is what I've been saying for a couple of weeks / months here. I never expected it to break down this precipitously. But once you break down and you get below $30, then you're in a world of hurt. You look at that 26.55 level. So I do still think that people, for the most part, want lower oil. They don't want it for this reason. But ultimately, a bunch of companies are going to go out of business. It's going to be survival of the fittest if anyone's left. And then we'll recoup, regrow. But until that, I think you're going to see lower for longer. Yeah, and you heard Mike Bradley say it, 15 to 20% of the equities could be gone away. And by the way, many of them are down 99%. I mean, literally, that's a number. All right, the market crashing through several key technical levels in today's brutal sell-off. Is there any support anywhere out there? Cornerstone Macro's Carter Worth over at the Plasma. Any support anywhere, Carter?
Rubbing his hands together,
you could just pick your levels. But let's first talk about the concept of a bear market. Now, headlines always focus on the 20%, and really no one knows where that came from. But let's use that. If the Russell 3000 is the broadest investment aggregate we have, covering essentially the entire investable universe, which is obviously the S&P 500 plus the next 2,500 stocks, these are the numbers. 2,467, 83% are already down 20. So is that a bear? Or how about down 25? 72% of the constituents are down 25. Or let's go a little further. How about 30? 60% of the constituents in the largest aggregate we have are already down 30. It's a bear market. You can call it what you want. We know what it is, and it's presumptively not over. Where can it go? It's anybody's guess, but let's look at some lines. So actually, same deck here for the S&P, and this is the point, right? 20%, 66%. More than half are down 25. So we have a few big marquee names that are holding it up. As if and as they succumb, we know what happens. So in terms of levels, here's the long-term chart. This is the financial crisis low, the 6th of March, 2009. This is the U.S. debt downgrade in 2011. Right here, the 2016 industrial earnings recession. Right here, the plunge low of December. And so were we simply to come down to trend, which is 2,500, that's another 7%. Perfectly reasonable. But the real question is, could we get to the December lows? Could we give back this entire ricochet of the past year? We know the S&P is not it, but the transports have already taken out the low. The bank index already taken out the low. The Russell 2000 and the energy. So let's look at each of those, and then let's quit. The S&P, were to get down to its ricochet low of Christmas of 2018, would be another 15%. The Russell 2000, on the other hand, would be a mere 4. Just 4. That could happen tomorrow at 9:32. Could happen next week. But the point is, that's a foregone conclusion. And then here's the real issue. Look at some of these other aggregates. What we have is the transports. The transports have already taken out their Christmas low. And the key here is they never could make a high, never confirming what the S&P was doing. And finally, take a look at the bank index. Never confirming the S&P's new high, and has taken out the low. None of this is good. And sure, you can get bounces along the way, but bear market, got a lot of problems, and let the dust settle before getting really excited about buying.
Yeah, we'll see if the dust does settle. Come on over. So Karen, if you look at Carter's chart there, I think I did the math a little bit. We're looking at about maybe we could have another 7 to 9% down on the S&P 500 to hit that 2,500 super long. Nice elbow bump. If you're on the radio, they just bump elbows.
Practice.
Super long-term support.
The trend line, right? Think about it. Those are pretty important reference points. The 09 low, the U.S. debt down in 2011, the 2016 low, and the 2018 low. Were we just to simply touch that, that's 7%. But from there, it's anybody's guess. The real issue is the market, which made a new high, was never confirmed by most global aggregates, by the banks, the transports, and it calls into question whether we do really test the December low.
So you had talked about the Russell as being only 4% off of that.
That unbelievable plunge low, at which point it was itself was down 30%.
So does that make it more attractive to you relative to the other ones? Or not on a relative basis? I won't hold you to an absolute.
Yes, that's one way to look at it. One could say, since it's so much worse, therefore it has more bounce potential. But I think it's because it's got so many things that are playing. First of all, its weighting in financials, as you know, is almost double that of the S&P, and small regional banks with rates and so forth are in real trouble. My hunch is that it's just it's a preview of coming attractions for the bigger indices.
And coming attractions are not things we tend to like to sit through.
I like the coming attraction.
Sounds like a coming attraction of a bad movie. I mean, the bottom line is you see more downside likely ahead.
I think that's the message that I would convey, but I think it's also this. Let's say it's not about the downside. Switch the subject. Let's say we never go lower. There's always downside in investing. We know that. This is not tiddlywinks. It's about the upside. The upside is capped. If you look at the statistics on how long it takes to recover from a 20% decline, the median it takes about 2 years. That's right. That's a problem.
And this may be where you're getting to, but let's cut right also to literally the shape of these charts. Investors are become so inured to expect a V-shape recovery, and we talk about it in the context of economies. And is it going to be a V-shaped recovery from the coronavirus? Who knows? But the charts themselves, that's a big ask. And
especially since we had the V off of the December.
Well, that's the reason they expect it.
V, right? And usually you don't. Meaning it's tricky to pull off a V. They're rare. U's are common. You heal, you cure. Ricochets are impetuous, impulsive, and they're rare.
All right, Carter, good stuff there on those charts. I mean, really long term, that Russell chart was incredibly dramatic. Carter, thank you very much.